Today on the CEO Barbecue, we're looking for gold in Nevada together with P2 Gold. For a bullet point summary of this and all other CEO interviews, please go to researchtalks.com and subscribe to our free weekly newsletter. The company you're about to hear from has paid us for the production of this interview, but this interview is still intended only for experienced speculators because this is venture capital and mining is a very risky industry where failure is the norm. All conversations are general and impersonal in nature, and they contain forward-looking statements. I'm not a licensed financial advisor, and my business sells content-producing services, which also makes me biased. So before continuing on, please talk to an independent investment advisor with a good long-term track record because your capital is at risk, and also visit setterplus.ca where you'll find the company's official filings. If you're not 100% sure you understand all the biases and the disclaimers that I just showed you, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said herein. That all said, now this is not P2's first time on the barbecue, so if it is your first time watching or listening, I'll link the previous interview in the description of this video. Please watch that if you haven't yet, because that's where we did, we talked about incentives and background and everything else, did the smell test, and I did the main part of the grilling back there, so please do go and watch that. In a nutshell, though, the story of P2 is, again, one of gold in Nevada, where they recently published an updated PEA, and that's also the main reason Joe's back on the barbecue today. The PEA is about a month old now at this point, and it showed the potential for a 14.2-year LOM operation, starting off with heap leach first and then adding on a mill addition later down the road, which, of course, we'll talk about. The base case was calculated using $2,350 gold, $29 silver, and $450 copper. And the after-tax NPV5 showed close to $1 billion in NPV, $943 million to be specific, and an IRR of 33.8% with pre-production capex estimated at about $380 million to be paid back in 2.5 years at the base case. All that means modeled LOM production could sit at around 1.5 million ounces of gold, 2.5 million ounces of silver, and about 213,000 tons of copper. Now, is that everything that Gabs has to offer? Could this grow from here on out is definitely a question I look forward to asking, because last time Joe and I spoke, he told me he sees 5 million ounce potential at this project. And that was about 6 months ago. So I'll be asking about that as well. The near-term plan for the company is to convert the inferred to indicated through infill drilling, continue doing the met work to optimize recoveries, get the water rights, and maybe start working on the permitting process and engagement. All of which we'll hopefully again touch upon later on. P2 is listed as a PGLD on the TSX Ventures Exchange, where the average 3-month volume is close to 700,000 shares now. The stock's 52-week high is 51 cents and its 52-week low is 5.5 cents. With a market cap of just under 83 million Canadian dollars and just over 236 million shares outstanding to date, this is a 35-cent stock, with a 50 and a 200-day moving average at respectively 30 and 15.6 cents, which means the stock is now trading above both of them. P2 also has a new financial statement, a rather recent one, which shows the numbers as of September 30, 2025. Cash and cash equivalents at the time sat at $11.3 million after having done a financing this summer, with a bit of marketable securities on top of that. Those are in the form of roughly 1.5 million shares of Kingfisher Metals, as well as some account receivables on top of that, for a total of, let's call it $12 million in current assets. I see no long-term debt here besides a very small lease obligation, but I do see about $2.6 million in current liabilities. That's mostly in the form of convertible debt and related party loan payables, which Joe and I will probably touch upon again later on in the conversation. Moving on to the P&L for the 9 months that ended on September 30, the total administrative expenses show as $755,000 in total, although that includes about $100,000 in share-based compensation as well as some depreciation. So the actual monthly out-of-pocket cost for the last 9 months was an average of just about $70,000 a month. G&A itself was just under 60% of that, and investor relations together with travel and shareholder information was about 33% of the spend. Again, this is a more advanced stage company than your typical explorer, so they were mostly working on the PEA for the first 9 months of this year. So the exploration and evaluation expense for this period shows as just about $466,000, but that may change soon, given that an RC rig has recently been mobilized for a 4,500-meter drill program at the Sullivan Zone, which holds about 60% of the resource that the PEA is based on, where, again, they'll be trying to upgrade the inferred to indicated, but they also believe that could increase the gold grade. So that's something, including the cost of all of that, something I can ask about later on. Normally, also, this is where I'd provide a breakdown of the exploration expenses, as well as look at the ratios, such as your drilling to marketing ratio and the exploration to administration ratio. But again, that doesn't really make too much sense here. But please do go and look for yourself. Visit setterplus.ca, where you'll find the company's official filings and financials, because further due diligence is required. Enough number crunching from me now, though, and it is finally time for me to shut up as well. And Joe, I'll let you do the talking here. But first of all, thank you so much for being here today.
Yeah, thanks. Always a pleasure.
The pleasure is mine, and I am looking forward to diving into some of the details on the PEA. Maybe a couple of housekeeping notes first here, though, and talk a little bit more about some numbers. You raised $11 million in September, but you'd initially set out to raise just $6. So what happened? Why take more if you thought you could do it for less?
Well, we had big demand. It was actually we cut back a lot of people. We were probably at demand of 14 or 15 million. We settled on 11 million. A couple reasons, but mainly we looked ahead. Okay, what do we need to get through feasibility? And so we have some warrants coming due. I'm sure you'll ask about that in a minute. But we have some warrants coming due in the coming year, and we feel between the cash from warrant exercises and that 11, that should get us pretty much through feasibility study. And so that's why we thought, okay, let's it's dilution, but on the other hand, it will allow us to do expansion drilling as well as infill and move us through feasibility. And we expect to get a re-rate after that. So I think the cash is well worth doing at that price at that time.
I do want to talk about the warrants. Just before that, though, what do you think is the kind of the rough breakdown here in terms of who participated? What is it largely taken up? Is it retail, institutions, insiders? What did that?
We had about we actually had insiders. There was a bit of insider participation in the first round. We had, I was going to buy some. We were all going to step in and buy some more. We like the stock. We think it's a good value, but we cut ourselves back just because there was so much demand. Had a lot of existing small shareholders were interested in, taking a bit, and so you have to give priority to those guys. We had a fund out of Singapore that came in for a nice chunk. We had a big family office come in for a chunk. That was probably between those two, we're probably looking at over half the financing. And so that's why we upsized. Not only did we bring in cash that we could get through feasibility, the other thing is that there were a couple of shareholders we really wanted to get on the shareholder register. And in order to do that, we needed to upsize.
Any names you can share with me?
I don't think we've announced it, but I'll leave that off. Yeah, good solid shareholders in for the long term and looking to see us put the project in production, they're not like nowadays you see a lot of guys that are just come out right and say, look, we'll participate in your financing. We're trying because we had a warrant. We're just trying to get a warrant bank going. And so they're going to, they take the unit, they sell the stock immediately and just sit on the warrant. And so we turned down, a chunk of that kind of money because we were looking for guys that or investors that were looking, that were to stick with us through to a re-rate into production.
Yeah. Warrant clipping seems to be like a very, very Canadian, culturally a very Canadian thing that happens. I don't quite get it, but
I think it dates back to the Vancouver Stock Exchange like 30 years ago and how guys would, they do their 5-cent financing, blow off the stock and sit on the warrant for a couple of years.
That's fair. Interesting though that half the financing has been taken up by two parties. You said no names. Anybody I'd know though? Is it mostly like resource funds that are taking it? Is it generalist funds? I'm just kind of trying to understand who are your partners here essentially.
One's a fund, but closer to a family office in the fund, and the other one is truly a family office. So, a couple family offices that are believers in gold, and saw the value in P2 gold. We were trading at 20 cents, and you look at our project, and based on the PEA, even the older PEA that we put out last year, the project's a deal. And so just attracted the investors that were looking for a long-term hold.
And you also gave again a full warrant with that financing. That's actually already in the money because it was at 30 cents in that financing. Why? Why did you have to do a warrant for this financing? Was it any of them asking for a warrant? Again, especially given the backdrop of the market and everything, why did you have to do a warrant?
Well, you have to remember when we did this, we had been at a month before, our stock was at, I think, 25 cents, 26 cents when we set the price at 20 cents for the unit. If you look back a month before that, I think we were at a dime. And so our stock had moved up quickly with the move of investors finally starting to filter down and take a look at the junior developers. And so our stock had come up rapidly. And so we just thought, look, in order, you often get pushback from our experience over the years. If the stocks come up a lot, people say, well, look at how do I know it's going to stick? And, we want a bigger discount or we want a warrant. And so, look, we thought we wanted it to be successful. We want to move on. We want to, you got to remember the last, couple of years, we financed the company ourselves. And we thought, look, let's just get the cash in so we can push hard on the feasibility, move the company forward. We'll create value for shareholders so that this will not be as dilutive as people talk about dilution, but the alternative is, okay, you sell a royalty. Well, you're diluting at a project level if you sell a royalty, and it comes right off the top. I'd rather keep the project clean of a royalty and make sure we have cash in with equity. Look, we can always buy stock. We get going into production, we can always buy stock back and cut back on things, the share count back. But I know I'm rambling here, but we wanted the financing to be successful. And so we put the warrant on, and we believe it was in the best interest of the company. You got to remember, our combined management holdings are the biggest shareholders in the company, and we were willing to take the dilution because we believed it was the best for the company. So, we are incentivized to move things along quickly and with the least dilution possible. But we thought this was well worth it.
How do you manage the warrant overhang from here on out? Is this something you can do? I think there's an acceleration clause to it, or do you have any specific catalysts coming up here that you think are going to help you manage that?
Well, again, let me just give you a little background on the warrants. So we have about 28 million warrants coming due between now and mid-March. Well, so they're coming due in February and March. And then we have about another 20 million coming due in September. We've already had 11, 12 million of those warrants exercised. So we've already had a significant amount exercised. Management owns, off the top of my head, we're probably about 8 million and change of those warrants. So we're probably, you put that together, that's 20 million of the 48 million warrants that are coming due next year. So maybe another 28 million to be exercised over the year. Catalysts, like, I don't believe we will, you never say never, but I don't believe we'll ever force the conversion. I think the better way to deal with it is let this, if you force the conversion, there's a limited time, people just, sell the stock. I don't think that helps anybody. I think the better thing to do is, look, we've got a little bit of runway here. It's up to us to generate catalysts. We have RC drilling underway right now at the project. We should see our first holes, all goes well, say mid-December. And then from then on, we should be, consistently being able to release, drill results every, few weeks to a month, for the next, I'd say 4, 5, 6 months. So there'll be a lot of drill results coming out. We've got a diamond rig coming on site I'd like to say it's there today. We'll see if it makes it down there today. But within the next day or two, it's going to show up on site. We'll start drilling some met holes, some geotech holes. We'll do some assaying of some of those holes. So get some more news. So there's going to be a lot of drill result news flow. And our, as you mentioned in the preamble, there's potential for blue sky here to expand existing resources, as well as just blind targets that we've never had the opportunity to drill. So we may, all goes well. We once we get through our expansion and infill drilling, we might even do a bit of that. So there's going to be a lot of news from drill results over the coming 6-7 months, and so I think that will help generate the liquidity that we need to absorb those warrants.
How far is this money going to get you through that whole process and just in the lifespan of the company? How far does it get you?
I'd like to say it gets us through the feasibility study. I want to have the feasibility study completed this coming year, 2026. We'll say by the end of the year, but we'll push to get it done quicker. If all goes well, maybe third quarter. So we'll just push hard on that. So we feel we'll have the cash to get through the feasibility study and do a lot of the work, if not all the work we need for the mining plan of operations.
Mm. And well, speed's not being a problem, I think, in your case. Not even, and this is a bit easier than Bruce Jack, I would say.
No,
Just a
night
little
and
bit.
day different. Jeez, trust me.
Where do you prefer spending more time in the Golden Triangle or down in Nevada?
Well, I love the Golden Triangle. It's such a beautiful place, but it, you're it's tough to get in and out. We could do it in a day. I used to fly up for a day when we were in construction. We'd go up. I was up there every week, and sometimes you just go in for a day and make sure things were going well. Nevada, you can drive to. It's hard to beat Nevada because you drive there. It's 2 hours from Reno. It's 45 minutes from where we have our office in Hawthorne. It's it makes life easy. You're not banging yourself up on dirt roads or driving over a glacier or anything else. You don't need helicopters. I tell you, the one thing about the triangle is it is hard to keep your costs down in the triangle for exploration. We're drilling now. I'd like to say, we've just started, but I think end of the day, we're probably going to be drilling for 225 to 250 bucks US a meter, all in assaying geos and everything else. And you can't come close to that in the triangle. It's an expensive, you take your drilling costs and you double them to take into account the helicopter. So yeah, you really get a lot of bang for your buck down here.
And that's RC that you're drilling, but I think that in large part it applies to diamond as well. Do you still go to site though? I mean, at this stage of the company, are you required at site, and do you spend any time at site?
I'm not required at site. We have two really experienced exploration managers that we have at site. Both of them worked at Fortitude Gold, which is just has the Isabella Pearl mine down the road about, I don't know, 20 miles, and also worked their County Line project, which is on our southwest corner. So they know the area well. They know what they're doing. They've been in the business for a long time. And maybe not quite my age, but they've been around. And so we have a very experienced crew. I still like to go to site. I haven't been since earlier in the year. I will make it down there. I just figure out when, but within the next couple months, I'll be at site.
How much of your time would you say goes toward P2 now that you're also CEO of Tudor?
I don't know, at least 50. I'd say 50-50 right now between the two. Yeah, we have a team, 4 people that we've brought on that, our core group. We were all together at Silver Standard, where we discovered Bruce Jack, and then at Pretium, where we built Bruce Jack. We and actually the Tudor guys, if you know Tudor Gold, Ken Conkin, who was president before I came in, was with us at Silver Standard and at Pretium. So we were sharing an office. They were looking for some support on the management side, and we as a team said, okay, well, then there's a reason we went in there. I can get into it if you want to know, but yeah, so we came in and we had the time, we have the capacity, so let's push both projects. We're pushing hard on P2 right now with a lot of engineering studies and that. Tudor's more of your typical golden triangle project where you have a lot of activity in the summer, and then in the winter you're mostly just planning. So at this point, like right now, I'd say fair bit of time. I'd say 50-50 between the two because I do marketing for both companies and try to get the word out on both companies, particularly this time of year.
Yeah, talk to me about that though. Why the decision? Because you were a strategic advisor, I think, already to Tudor. Why take the helm?
Well, look at I was strategic advisor, and then in January, I went on the board as a director of Tudor Gold. In May, I had a call. They had asked whether our team was interested in adding some firepower to their management team to take it to the next step. It's 15 kilometers roughly north of Bruce Jack, the mine that we discovered and built. So we were intrigued by that. We know the resource because I was on the board. We were strategic advisors, and realized there's potential for a higher grade underground mine. Tudor Gold's got this massive, big discovery, bulk tonnage deposit in the Golden Triangle. They came to us. We were intrigued by the fact that we think there's potential for a higher grade underground mine there as a starter mine, that something that we could help them with and move it forward. So we said, okay, well, we've got the capacity, we've got time to do things right now, so let's help them out. So we've, as a team, moved over and are running both. We were already sharing an office with them, so it didn't require moving anything. We're just pushing ahead.
Right. Okay. That's fair. That's a good bit of housekeeping there as well. Last time, Joe, you and I talked about the royalty, talking about potentially selling it as well. Now we're talking back to P2. What's going on there? When are you going to sell the royalty?
Well, our view is if we don't need to sell a royalty, better not to. Our view is let's just move forward. We raise the equity now. When we were talking selling at a royalty, you got to remember there was zero equity available for junior developers, and with the equity showing up, we thought, look, let's take advantage of the equity because, as I said before, yeah, you're either diluting at the project level with a royalty, and that money comes right off the top, makes it hard to build a mine because it impacts your cash flow. It impacts your ability to fund the construction of the mine, especially if you sell a royalty too early. If you have to, you have to. You do what you can to get things built. Our preference was equity because, as I said, you can buy back equity. When we financed Bruce Jack, we did it as part of our construction financing. We sold a stream, but I think it was the first and one of the very few where we negotiated the ability to buy back that stream. We had 3 years from the signing up the deal to buying back the stream. After that, it would stay in effect. It was a 5% stream on our gold production. And we got in production, we raised some money, we produced gold, made money, and bought back that stream, and it really helped us get things constructed. Now, it was expensive money. It was 15% was the cost of the buyback on the initial money. But on the other hand, we had the mine built, and so you have to look at things at the time and what it takes and what kind of package you need to put together to build your mine. So from our perspective, look, we'd rather have equity at this stage. When we come to mine construction, well, then we'll look at it again. But in the interim, I believe we're cashed up. If we're not fully cashed up to get through feasibility, we're pretty dang close to it. So we'll just keep pushing along that way.
That's fair. And that it puts you at $11 million in cash right now at the start of the drill program. Maybe you can walk me through the breakdown. What's that money going to be spent on, particularly for the drill program, but then everything else, like in terms of percentages, how much money is the drill program going to cost, and then everything else?
Well, right now we're doing, but the plan is roughly about 15,000 meters of drilling at between Sullivan Zone and Lucky Strike Zone, just under 5,000 meters. I think we bumped it up to 4,900 meters at Sullivan in, I think, 24 holes. We're actually through about 10 of those holes already. Lucky Strike, we're looking at roughly 10,000 meters. So between that, so as I say, roughly 15,000 meters at this point in time. We may expand that depending on results. 15,000 meters at say 225, 250. We're looking, 3 to 4, say 4 million US dollars. So with the Canadian dollar right now, that's closer to 6 million CAD, 5 and change CAD, 5.5. So that's where that's going. And that is the big ticket item for the feasibility study. The engineering, when you think of it in terms of, okay, engineering and things like that's relatively cheap compared to drilling. So we have other studies underway. We've got a geotechnical study looking at our pit walls. We've let that contract. We're in the process of letting a geotech contract on our, leach pad, mill sites, just to make sure we're in the right spot to put those, to do some test pitting, do some drill holes over there, make sure that the ground's right for, just as a little side, we found over the years, and I think this is common for everybody, is your biggest areas of blowout on your CapEx are usually going to be in your civils. And so the more work you can do to solidify those numbers, make sure you've got the right ground conditions to put your heap in, put your mill in and all that, your tailings facility. The work you do up front really helps you down the road in keeping your costs in line when you're in construction, because those seem to be the areas where you have your biggest blowout. So we're letting that contract as well. That's underway. What else? We've got, your usual wildlife surveys. We've already done a lot of that. We're doing a bit more. Water, we're going to need to drill some water wells. We're just waiting on that permit. There were some issues at the Nevada Water Bureau where they, I believe the word I heard was they got hacked. And so that's really put them behind in actually dealing with the permit application. So, but we expect to get that at some point this quarter. And then we'll drill some holes. That's probably about $1 million US to get the water for production. We don't need both production wells. We just need one well to get our mining plan of operation. So about $500,000 US will go to that. And the rest engineering studies. There'll be some more money involved, but we feel with the warrants coming in, there's about, I'd say 5 million cash in warrants coming in, $5 to $6 million over the year. That between the 11 we have and that money coming in, we're 16, 17 million bucks. We're in good shape to do that. That convertible debenture comes due in January. We're budgeting to pay that back in cash. We would like to pay it in cash. I expect I held some of that convertible debenture and I converted. I expect most people will convert, but if not, we're happy to buy them back with cash.
What does it convert at?
It's a dime. It's from 2 years ago almost now.
Right. Yeah, you'd rather buy that in cash. That makes sense. Raising at 20 by 10, that makes total sense. Well, out of the 4,500 meters, Joe, how much is going to be stepping out versus infill?
Let's just say we'll probably have a couple thousand meters of that is probably step out, expansion style drilling, or at the fringe of inferred and trying to bring it in as well as add to it. So a couple thousand there, and then the rest within the more. There's some spottier parts of drilling where we have nice grade. We know within the ore deposit, we just never got around to infill drilling there before. So the rest will be in those areas.
So like 30-40% of that drilling goes to step out.
Yeah, I'd say so. 30 at least. And look at, as I said, if we're getting some nice joy in the drill results as we move along, we'll reevaluate. If we feel there's value in additional drilling on that, we'll keep it going.
How much are you stepping out? What's kind of the size of how far are you going to be drilling from what you know already?
Well, okay, we step out. We're trying to keep, with our step outs, keep things within that indicated category. And right now it's between 35 and 50 meters to get indicated, depending where we are in the ore body. So we'll step out on those bases and, drill and then drill so that while we're stepping out, we're still hitting, putting ore into the indicated category and not just expanding the inferred.
Okay. And then assays from, you said by December, what's the first you're doing? First is infill or step up?
We have some drill holes on the northwest margin to start with, which are uh, expansion. I'd say, there's a bit of infill, but expansion mostly. And those should be in the first round of holes that we get out of the lab if all goes well and they process the samples the way we send them. That doesn't always work the way it should, but yeah, I would hope by mid-December we're getting those first holes out, announcing those.
Mm-hmm. And that's all, part of that you're doing here, you mentioned, is at around the Sullivan zone, then where 60% of the resources, how much goes into the other zones? Are you going to any of the other zones?
Lucky Strike is about 10,000 meters into Lucky Strike, 40 some odd holes, 47, I think, off the top of my head, currently planned to get that up into the indicated category, and also for some expansion drilling on the western margin. There's some nice potential for some a nice grade gold on the western margin of it. So we'll have some expansion drilling there. There's also some structural controls on the zone that we want to really see if we can do a little more work on. So part of that drilling will focus on that as well.
Different structural thesis then than what you thought so far, or what's changing there?
No, just more looking at, we saw the structures in that, and we had the historical drilling. So we haven't, a lot of the drilling at Lucky Strike is in there was drilled by others before we came along. We've drilled some holes and we've analyzed that. And now we're going back in and proving that up. What we'd like to do is there's a little more strip at Lucky Strike right now in our model. We feel we can actually bring some of that ore closer up to surface so that we're reducing our strip. We're mining ore as we go down. So that's what we're going to follow, a bit of structure there to try to do that.
Mm-hmm. Interesting. How big do you think the expansion could be? How big could the resource get to? Again, you're not doing the PFS, actually, you're going straight to FS.
Straight to fees. We think out of this program, I'd be happy if we had 4 million ounces equivalent, maybe a bit more. But I'd like to say if we hit 4 on this program and show a path to 5, I'd be very happy with this program.
Yeah, that's exactly what I wanted to go with. This is like the 5 that you mentioned last time. You said there's potential for 5. Is that potential? Do you still see that potential, and how do you realize it?
I think we see that, and actually, I think more potentially. It's all potential until you drill it, right? But yeah, I think we're comfortable with the 5 and potentially more than that, and that's near surface. That's not, we have some targets at depth. We're focused on the near surface. The idea is let's get in production. We could, one bit of feedback we always have heard for years is Canadians seem to want to drill, and Australians like to get in production quicker. And there's something to be said to both camps, but we feel there's plenty where we're at. We currently have, as you did a bit of a run through the preamble, 14-year mine life, 14.2-year mine life, averaging 109,000 ounces of gold, and 33 million, I'll give it in pounds, 33 million pounds of copper on average life of mine. There's some lulls in our mine plan. What we'd like to do with this drilling is expand the resource, fill in those lulls where we're dropping down, our gold production drops down. And in feasibility, we'll actually do some modeling and see, okay, maybe 9 isn't the optimal mining, 9 million tons a year, which is our current mining rate. Maybe we should be at 10 or 11 million tons a year. We go from, say, 25,000 tons a year of ore of a 24,000 tons of ore a day to up to maybe 30,000 tons of ore a day. And we pushed the mine up to 150,000 ounces of gold. If we, expand the tonnage a bit, we do a bit better with grade because we have modern drilling. A lot of the drilling in the Sullivan zone was percussion drilling, excuse me, from the late 80s, early 90s, which is not the best recoveries. We feel that, with RC drilling, maybe we could pick up 10% in grade. And, that's significant.
I do have a couple of questions about the details, and I'll get to them here in a second. But has your goal changed? Would you want to be the one building this mine, or will it be time to look for a buyer sometime soon?
Look, the way we've always approached everything is you push to production. If someone wants to buy the project, well, they can come along, and if they're willing to pay the price that the shareholders are willing to accept, well, we'll sell it to them. But in the meantime, you push it out along. You'll find that my experience is you take a project along, and all of a sudden you say, okay, we're ready to sell it. It sits there for a while, and you don't create any value, and oftentimes you can drift down, and you're just waiting. You have zero control over things. You keep control, you be proactive, you push to production, and you create value for your shareholders. You can get a re-rate and everything else. So even if someone doesn't come along and buy it, because you get shareholders that, some are focused on production, some are focused on getting bought out. It's a mixed, but the way you keep everybody happy is you move to production, and if somebody wants to pay for it, they can.
Mm.
But the shareholders have to reach a price where it has to be at a price the shareholders want, right? No one's the days of Barrick saying they got rid of Bristow, or Bristow left, either way, but the zero premium acquisition days, I think, are long gone, and I don't think they were ever really here because you didn't see of too many. If you own an asset and somebody else wants it, you have to pay for it, and people want a premium.
Yeah, that's what I was gonna say. Is like that worked out well for him.
Yeah, yeah, it's very true, isn't it? Yeah, he's a nice guy, but yeah, like that did not work well.
Isn't the whole point of Canadian mining, though, Joe, to just get a PEA and then sit there, collect paychecks, and then 5 years down the road, redo the PEA, and then 5 years down the road, maybe do it again, and then a PFS in 20 years?
I'm not saying that doesn't happen, but that's not our way. We're big believers in, if you're not moving forward, you might as well not be doing anything. It was a little painful for us for the last couple of years when the market was really bad because we funded the company ourselves, and we had limited cash at that point in time, and so we couldn't really do too much, but we did enough to keep things going. We got our metallurgy going. We did this and that, and so yeah, you want to move forward. It's the way to create value. Sitting there with a PEA and updating it every now and then doesn't do anything for your shareholders.
Do you think Gab's sellable, though? I mean, at the stage that it is right now, could you envision it being owned by someone else? And who does the profile of the deposit that you have right now fit in?
I think it's a nice size. Look, it's not a Barrick or a Newmont project. It's a mid-tier project. North of 100,000 ounces. I look at I get the dailies from different banks and that, and you see these reports, and there's guys with market caps of 3 billion, and they're producing maybe 80,000 ounces of gold equivalent, right? Well, we just need to build this mine, and we're producing far more than that. And our market cap's now 50 million. If all goes smoothly, 3 years from now, we're in production, and we should be getting a re-rate up into the billions of dollars. So there's value there. And that's why you push ahead to create that value. If you just sit here, somebody will come along. Eventually, someone will come along and say, okay, we'll give you, your market cap's 50, we'll give you 60, or something dumb where you're just giving the project away. That's not the way we work.
Mm. What do projects in this setting, again, everything Nevada, but it's metallurgy, type of deposit and everything else, what do they sell for on an MPV basis?
It's hard to say. You know what? You see stuff going for, you know, eh, 0.25 of the NPV. I've seen a deal recently. But what NPV do you take? What base case? If you look at ours, our NPV 15 is, geez, from memory, I think our NPV 15 at base case is roughly 300 million bucks. Well, we're at, and that's an NPV 15.
Yeah.
We're trading below that now
Hmm.
at our 50 million US. So.
It was interesting to me to see MPV 15 in there. I think a lot of people run it at 5, and I actually don't like it at 5 because you're not financing nothing at 5 at this point in the economy, right? So I do appreciate seeing the 15 there.
Yeah, look at, historically, well, for the last, I don't know, 25 years, probably, they used to run NPV 0, I think, for gold companies because it said that, well, inflation, gold goes with it. And then they started running NPV 5, while, base is what, 8 to 10. I think the Aussies use 8 more, but North America seems to standardize on 5. We like the fact we stress it hard just to show that, look at, we're 3 years away from production. Let's stress this hard to show that there's value there, even at a big discount.
Mm-hmm. Let's talk about some of the details here in the PEA. What is the slope angles maybe first? How sensitive is the proposed operation to, let's say, a 5-degree change in the slope angles? How does that change by sector of mineralization? Maybe talk to me about that.
Yeah, I can't give you the exact numbers on that, but where it really shows up is in our strip. So, the steeper the angle, the less strip,
Mm-hmm.
and the less initially capex, and then less sustaining capital. So I can't give you that number. I haven't actually run it, but we're running 45, 43 degrees on the pit walls, and if we can steepen that up to 50, well, you steepen up a little bit, you're still saving money on strip.
Yep.
And so, yeah, it's just a general number.
How's the neighborhood situation? Sort of your neighbors. What's the land around you?
Well, no, well, Paradise Peak Mine is on our southern border. It's a historical mine. It was a high-grade silver gold mine run by FMC, which became Meridian Gold it was operated, I think, late 80s through mid to late 90s. So it's still there in care and maintenance on our border. The County Line project, which was a small open pit that was run there and a heap, has been re-permitted by Fortitude Gold, and that's on our southwest border. The trend that they're drilling and planning to mine off that historical open pit actually runs onto our ground, and we don't have any of that. As I say, there's lots of potential on our ground. We're going to look at the extension of what they're drilling that comes up into the southern portion of our ground. Once we get through our infill and expansion drilling of the known zones, we'll take a look at, maybe we could poke a few holes down there just to see how it looks where it runs onto our ground.
Well, really, why I'm asking that is just thinking of whether you can play around with the slope angles enough so that you're not, spilling out of your boundaries. And if you have to, do you have the ability to pick up more land?
We're well within our boundaries. The only real reason for working on the pit wall angles is for capex reasons. We don't have to worry. We've got lots of land. What are we, 45 square kilometers, and a lot of room between our existing pits and property lines.
Could you optimize the strip ratio for the FS? What do you think?
Yeah, we'll do that. That's why we're doing the geotech drilling.
Okay.
So that we've already let that contract. That will be once the core rig shows up, which, as I mentioned, any day now, conceivably today, we'll be drilling some of these geotech holes right away. First at Sullivan and Lucky Strike. Carbody is just a small deposit, 100,000 ounces of gold. So we don't need to do too much work there on the. I think we could probably wing that. Maybe we do a hole or two, but really it's Lucky Strike and Sullivan where the main pits are going to be, and that's what we'll focus on.
If you're giving it away, I'll take it.
Yeah, yeah, exactly.
What about yeah, what's possible? What's doable in terms of strip realistically here? What's your expectation?
Well, we drive up the road past. I don't know if you're familiar with Lahontan. We go past. They've got the historical Santa Fe mine, um, and so they're right beside the highway. You park the car, you walk up on the berm, you look at the pit. Their pit walls are probably 50 to 55 degrees. I can't give you what that is in saving, but that would be millions of dollars in strip for us.
Hmm. Yeah. That's actually an interesting point there. It'll be interesting to see how that develops over time as well, and how sensitive really the EFS becomes to that. Um, any idea on what prices you're going to run it at? I mean, base and spot. Again, you did this relatively conservatively. Your base case doesn't start with a three, I suppose, which it could. Is that what you're going to do for the EFS, or what are you thinking?
Well, we'll keep looking at, historically people used to use a 3-year trailing average. I'm not really sure that means anything. 2350, we'll look at, I think what we'll look when we set prices, and we'll have to set them in the next, probably by March, April, we'll have to decide on what our pricing is going to be. We'll look at, consensus, which is always a bit behind, and then take a reasonable discount. We're comfortable with sticking at 2350. The project's robust at that. We might bump them up a bit if gold's still at 4,000 and people are thinking that gold's going to stay there, which we think it will stay there. But you want to be conservative to show that look, this thing can weather the storm if metals turn south. So we'll make the decision, like I say, in about 6 months. But we're comfortable with our current base case prices.
I think now you also know a little bit more about your copper metallurgy, and I think you're going to know even more by the time it goes to FS. Talk to
Mm-hmm.
me more about that. SART or SART, I suppose. Talk to
Yeah,
me about
yeah.
that.
SART. So for our oxide copper, we're using a SART plant to recover, and our recoveries have gone from with our phase 3 metallurgical recoveries. They've gone from 54% that we used in our May 24 PEA. We bumped them up to 67% based on our PEA that we just put out.
Hmm.
So that's on October 7th. So that's a nice bump, and the copper responds well, and so we're doing more, but we're comfortable that copper is going to stay in that range. We had quite a significant size sample that we ran to deal with that, and we ran some other sample that we had on hand from some core drilling that we'd done, and copper performed well. So did gold. The gold comes out, great. Like, copper went up from 54 to 67, but gold went from what, 78 to 85. And when gold's at $4,000 at every percent, boy, it delivers cash, right? It works well.
Sulfide silver recovery, though, still modeled at only about 50%, which is not great. Is there anything you could
No,
do to improve it, and are you planning to?
we'll we'll look at it. We won't look at. We will work on that. We already started the metallurgical work for uh, the feasibility. We need to get some more sample in the lab to continue it on. But as we get our diamond core drill on site and drilling, we'll get, that stuff will all beef up and get going quicker. Silver, it doesn't make a lot of sense to put too much focus on the silver. The real primary drivers of the project are gold and then copper. Silver, at 175,000 ounces a year, it's nice at the margin. And so it gives us a nice little bump at the margin, but going from 50 to even from 50 to 60 is not going to really, it's almost a rounding error. So
Hmm.
there's a little bit there, but focus on the gold and copper is the way we're going.
I suppose from a streaming perspective, it doesn't make too much sense either. Like maybe I was thinking maybe you could optimize enough so that you can sell a stream on it just on a silver or something like that.
Yeah. Again, it's such a small amount, at 175,000 ounces a year. You're not delivering a lot of cash to the streamer, so they're not going to pay you that much. And then all you end up doing is encumbering your project, which impacts on your ability to finance for construction or
Right.
look, never say never. If the right deal's there, you got to look hard at it. But our preference would be just to let the silver come out, we'll sell it. But yeah, never say never.
If you're giving it away, I'll take it. I'll keep saying it. But so essentially, Joe, you're correct me if I'm wrong, but you're leaching the milled sulfide tails with cyanide. You're then washing them in a CCD circuit. Then liquors will then carry the dissolved copper and silver plus a cyanide, and then you run that through the SART plan to pull out the copper and silver as a sulfide precipitate and regenerate cyanide for recycle. Right? And is that what's happening first of all? And then also, is that an operationally or permitting wise challenging process?
We're running it through the SART first, and then pulling the copper. I think when we're in the mill, you're going to find most of the silver is reporting on the float side, that from what we've seen to date. But we'll do more work on the tails as part of our feasibility metallurgy. On the permitting side of that, we don't really see issues just because there's a lot of cyanide. But Nevada's home of the heap leach, right? And everybody's heap leaching. People are comfortable with cyanide. You have to deal with it properly. You have to respect it, because it is it is cyanide. But they're comfortable with cyanide and permitting in Nevada. A SART plant really is just regenerating the cyanide. I expect, to make things, for security, safety wise, and that we'll have a cyanide destruction plant built into the mill. But I'm not expecting anything untoward in our permitting process.
Do you have a comp? Like, is someone doing that right now in Nevada that we could look at?
No, that's the issue with Nevada. There are very few of these gold copper oxides that are around. Where there might be some silver gold oxide, but what they do is they just don't worry about the silver in it. There's not enough of it to muck up the circuit. The issue that we have is because there's a significant amount of copper, without the SART plant, it would just stay in solution and eventually just impact on actually your gold recovery as well. So not only do we improve our gold recovery by getting rid of the copper, we get a payable from it. So no real comps. They're just not. I'm not saying that there are no other deposits, but it's like everything. Everybody's been looking for gold in Nevada and silver in Nevada. I don't think anybody really put a lot of time into copper. So we may see more of these come, but I expect we're at the forefront.
Does it require more water? I know water in Nevada is kind of a touchy subject, as it is in a lot of dry places, but yeah, does it require more water?
No, it's going to be the same amount of water because you're doing the same amount of leaching. I'm sorry, it's popping up on my screen. You're doing, our water might nominally be a bit more at the margin, a bit higher for the flow, but not really. We have historical water well approved, was actually permitted and drilled and used for a bulk sample by Glamis Gold, I think in 90. So with sufficient water to meet our needs. So we feel there's sufficient water there and we're not having to go elsewhere to find it.
What is the water situation for you right now? Where do you source it from? What do you have to do?
We truck it in for our drill programs. We have a large one of our service providers has a very large bladder on site. He trucks in with his water truck, fills up the bladder, and then we run off the bladder to our drill rigs.
That's now for drilling. What about for if you go into production? What would that look like? Where's it going to come from?
We'll have a couple wells. We'll have 2 production wells, 2 monitoring wells. So for each production well, there's an additional smaller, say like a RC hole equivalent, as opposed to a big, foot diameter well hole to monitor. So we'll have 2 production wells. We've permitted To drill 3, we have those permits in hand. We're just waiting for our water rights to be issued by the Nevada regulator on that.
Is it just a question of waiting, or is it more work to be done in terms of paperwork for the permits?
No, everything's in, and as I said, from what I understand, the holdup is that they had a bad hack, and it's interfered with them being able to do stuff. So, we have to get down there and meet with them at some point. But no, the paperwork's in, and we're just waiting for the water rights.
Do you have someone on the ground kind of engaging with the community of Gabs? Again, it's the town of Gabs that you carry your name from. So yeah, what is that?
Well, our local exploration managers do a bit, but really we're going to start that engagement once we have a bit better handle on exactly what we're building. We've had some engagement to now, but we'll step it up as we have a nice definitive plan of what we're doing so that we can get out and really tell people, okay, this is what's going to be. This is, right now, I think we're employing about 220 people, which is always something that people want to know, okay, well, how many jobs are there? But we want to get these numbers maybe a little firmer up, and then the bigger engagement will come at that point in time.
What else do you need in the meantime? Other surrounding like BLM, NEPA, NDEP, air quality, anything else that you need in the meantime?
Well, that's right. We need, well, first off, from BLM, we need, feasibility, that's in our hands, and we can push that ahead. Permitting, first step is our mining plan of operations. We have a significant number of the studies underway that we'll need to do that, like a big cultural study that, examining the grounds. We have that going. We have the wildlife and other things, the water. This is where we have a bit of a hold up because the U.S. government shut down, so BLM is shut down, and so we haven't been able to get in to have our initial meeting to sort of kick things off for a mining plan of operations. So what we're doing in the meantime is, well, we're getting the studies underway because we know they're going to be needed, and then when BLM is able to get back to work and I'm sure they're going to have a big backlog. Once they clear that up, we'll get down there and meet with them, kick off our mining plan of operations. We'll get through that. Coming out of that, we'll have a decision as to whether we need an EA or an EIS under NEPA. And then it's a question of an EA, conceivably, we could get it done in a year, maybe a bit less. EIS, probably north of a year, closer to 2. But those are things we need to get in and talk to BLM and move things along that way.
Given that there's a slowdown there, is that going to slow down any of your plans? I mean, you just go to the FS and you keep doing your thing, or what is a slowdown in the government going to mean for your timelines?
I don't think it hurts us at all because look, at some point they're going to be back to work, and I don't doubt they're back before Thanksgiving. There's a lot of hardship for people. If you're working for the government, you haven't had a paycheck for, a couple months. That is hardship. And so I think at some point the politicians will get, sit down, talk, resolve, to, come up with some kind of compromise where they're back to work, in not that much longer. And in the meantime, we've got all our studies going on. So sure, you want to sit down with them and get their thoughts on, okay, what they want to see and all that. But there's a lot of things that they want. There needs to be a big cultural study. You need all your wildlife surveys, your raptor studies, all those things. So we have those things either done or underway. So I don't see it slowing us down at all. It would just nice to be able to check the box and get going and making sure we're doing everything they want. I think we're in pretty good shape, but you never know until you sit down and talk.
Power, how do you deal with power in this in a proposed mine plan right now?
Well, we have a power line running through the property. There's a major transmission line that actually comes up to the Paradise Peak Mill on our southern border. So right now we just show I can't remember the actual CapEx for it, but we just run a line over to our operations from there.
Right. The power line that runs through your property, that would that need an upgrade, or how big is it? Can it carry a mining
We
operation?
would upgrade from the property border where that Paradise Peak power comes in from.
Okay.
I don't think there's sufficient power on the current line.
Yeah. Okay. Probably still easier to deal with than in the Golden Triangle still.
Oh, look at it. It's going to be a couple kilometers, and you put some poles in. You should have seen we've got some fantastic photos. If I get I should get you some. We put a book together on the construction of the Bruce Jack mine, and we have some fantastic photos of. You've got these helicopter. Like it was all helicopter supported for construction of our transmission line. We had two. There are two of the they're the two longest spans in North America, going over glaciers, both over 2 kilometers that were cable was run. It's just spectacular. This is like, you can pretty much use toothpicks and run the cable over to the mill for, a few kilometers. It's nothing.
I did spend some time in the Golden Triangle this summer myself, and there's a beautiful power line running through Highway 37 there now.
Yeah.
But that was different, I suppose, when you were first exploring.
Well,
Yeah.
what happened with us is we couldn't tie into the Northwest Transmission Line because the government told us it was already fully allocated, which turns out, those projects still have not been built, and Bruce Jack's been operating for, getting close to 10 years now. So would have saved us some money running it from the Northwest Transmission Line. We wouldn't have needed the helicopter support, but you do what you need to do to get things built, and so we built a 57-kilometer transmission line to the south.
What do you then? I mean, we're talking about water and community permits and power and everything, essentially looking for potential bottlenecks and stuff that might slow you down or make it more challenging for you to do something here. What do you see as the biggest challenge or biggest unanswered question right now from here on out?
Our biggest challenge, and the reason we bought this project in 2021. And the reason we bought it is we looked hard at it, had lots of potential for growth, had to be bigger than what it was. It was, I think when we bought it, it was like 1.8 million ounces gold equivalent, 1.2 gold, about 600,000 copper of equivalent. We could see a lot of potential in that 4 to 5 million near surface, and we still see that, or maybe more. Infrastructure was great, coming out of the triangle where everything was helicopter and this and that. There's roads all over the property. There's pavement through the property. There's water on the property. There's power going through the property, but also right on a major amount of power right on a property line. Yeah, we bought it for all these reasons. So our issue has always been capital. We funded most of the GABS advance because it's not flow throughable. It's in the United States. A lot of that money came from us ourselves, and so our capacity. We've put a fair bit of money in, but when it's not much when it comes to mining, because mining's capital intensive, and so capital has always been our issue. With this recent raise, we feel that we've solved that because as we get through feasibility, the further you advance, the closer to production, the easier it is to get money. It's the irony of things when you're early stage and you can really use it, it's not there. And then as you get closer to production, everybody's offering you money. So.
Well, a few people are always offering me money, but again, if you're offering it, I'll take it. Waterton is Waterton is maybe worth touching upon here as well toward the end of the conversation, but they're selling, they have sold some shares. They still have quite a lot. Last time we spoke, you said, their exit strategy might be going to be surrounding sort of finding a fund or a strategic to sell a block of those shares to. SETI says they're being selling into the public market. What's going on there? What are they going to do with the rest of the shares?
Well, they sold, as far as I haven't spoken to them of late. They were willing to sell a bit of stock to lighten up a bit, but all our discussions with them have been, look, they're looking to see the project go in production. They could be selling now. They're below 10% of our issued outstanding, so there's no requirement to file insider, so I can't really speak for what they're doing.
Okay.
But they were always when they were always good for us to deal with. They're.
Well, there hasn't been too much pressure in the stock price. Stock price has come down a little bit now with gold. Obviously, the market thinks we're back in a bear market, which is funny at 4,000 gold. But I mean, the market will
Yeah.
do what the market does, and so it doesn't seem like there's too much pressure. But yeah, how do you do you still have an open line of communication to them? Could you still kind of manage the outflow of shares from their perspective?
Look at I don't look at we have no call on their ability to do things. However, the one thing Waterton is they are sharp guys, sharp team there, and they know how they've done a great job of making money over the years. So, they're going to look to maximize whatever value they can for that stock we have. So, they're not going to just say, "Oh, I'm going to blow this stock off, take the stock down to dime." They're going to maximize whatever they're doing when they do decide to sell. So we have comfort in that.
Yeah. How do you feel about the valuation of P2 gold right now? Again, it's better than last time we spoke, but you also have the PEA, so you have harder numbers to it. So I guess it sounds like a cheesy question because you almost have to say that it's undervalued. But how do you feel about that?
Yeah, boy, if I said it wasn't undervalued, that would be the first time you heard that from a CEO, I bet. You just have to look at I look at it. Okay, we're at NPV 15 at metal prices that are, if not 50, they're not 50% lower, but they're substantially lower than spot. And you still have a 300 million NPV 15. And we're trading it. We were at about 50 million US. I think we're a bit less than that right now. So if that's not undervalued, at spot, look at our spot case for our PEA, the numbers for there are, well, gold at least is below, gold and copper are both below where we're currently trading. And we're almost $1 billion of NPV 15 and roughly 50 million US market cap. So if that isn't undervalued, I don't know what is.
Well, it was a bit of a trick question, I suppose, and I have heard people saying, well, I think we're not entirely undervalued, but what we're going to do is we're going to add on more value, and that's going to make us undervalued. But what about for yourself? I mean, if you're undervalued, how do you fix it? How do you fix the disconnect between the price and the value?
Well, it's up to us. We have to get out and market and get in front of people and get the story out more. You have to remember that for about 2 years there, we just were pretty much laying low and working our way through a very bad market. It was a bit of a desert for junior developers, and so we didn't market. We just we had one conversation, the two of us, about a year ago, if I remember right, but very little marketing. And so now that we are doing, we have lots to talk about. We got to get out and market, tell the world about it, tell them how good the project is, show some results that back up what we're saying, and just do that. It just requires consistency and we just have to get out there. I don't know how other way to do it. We have to get the story out. And we're looking at one reason we're talking to you. You know a lot of people. You have a following. We want to talk to you, help you can by interviewing with us. It gets the word out and talks about lets us explain how good this project is and how quickly we're going to move to production.
What else are you going to do in terms of, are you going to go on, I don't know, are you going to do other interviews? Are you thinking of sponsoring someone, conferences? Yeah. What's kind of the mix you're going for?
Well, we found from a retail perspective, I think these interviews seem to be the best. I'm not sure the retail conferences are what they were, say, 20 years ago. So we are doing other interviews as well. We try to have a consistent rollout of interviews every couple months, where giving people an update. It's the best way to update people on a project is when we're sitting talking. So I think those are great. Few conferences that we'll attend where we're looking more for institutional. I think that's where we need to get to now. We've got got a great retail following, a great retail base. Now it's time to bring in some institutional shareholders to help take us up to that next level.
Do you think your G&A is going to go up? Are you planning that? Because it's actually on the lower end right now for a public company. You're at about 70 grand Canadian a month on average, or you were over the last 9 months. What do you think that's going to go up?
Yeah, it'll go up a little bit just because we'll put in a bit more marketing. Not huge on a monthly basis, probably, I don't know, 10, 20 grand. And we're going to bring on we're looking to bring on someone to sort of sit on the permitting to help us with the permitting side.
Right.
Because I think that is critical path for us. So we're comfortable pushing the feasibility and everything else. But for the permitting, we'd like to get somebody in dedicated to just focus on the permitting.
Got it. Joe, I know you have to run here. We're actually probably a little bit over time as is. What am I forgetting to ask you? What did you come here hoping to talk about that I failed to bring up?
I think you pretty much hit everything on that. I think one thing you mentioned early on was we have some what is it, shareholder loans in that, and I'll just say that on our balance sheet when times were tough, we had a $550,000 loan from Ken loaned money in, so we've paid that back out of warrant exercises. We also have some non-arm's length loans on the balance sheet because we haven't taken salaries since September 23. So what we've been doing is we've just been loaning company money. So we will probably settle that out. We'll let the shareholders decide if they we'll probably look to settle that out with stock at our May shareholders meeting. We'll put it to the shareholders. If they vote in favor, we'll pick a price that's wherever the stock is at that time and look to settle it out that way.
So you're not taking the salaries that are owed to you. You don't think you're taking that in cash then?
No, we won't take that in cash.
Okay. What, you don't need money to live?
We're okay. How's that?
That's fair. I'll let you go. Thank you so much for doing this and hopefully speak to you again soon. Thanks so much.
Yeah, no, it's been great. Really enjoyed it. Thanks.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they are necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others, really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias. Again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should, under no circumstances, be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. So unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find the company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."